etc.
Right. So you have to identify that property in 45 days, and you mentioned the 180-day rule, so the whole deal has to be done in this 180 days.
Right.
But there is another thing that people need to be aware of, and that is if your tax return due date is not extended and it lands before that 180 days, that cuts it off. So you need to file an extension.
Right. So
this year.
the way the example there is coming up, we're actually very soon because we're in October as we're taping this.
Yes.
After October 17th, when you do the math, you'll find that the 180 days from that date through the end of the year for a calendar year taxpayer, if you close the first phase of an exchange in that 2.5 month window at the end of the year, that will extend beyond April 15th.
Right.
So therefore, you will not get a full 180 days unless you file an extension,
right?
Which then, of course, is automatic.
And it's not hard to do, yeah. So just do it.
Yes.
But it's the things related to exchanges and many other transactions is you have to really pay attention to the details.
Correct.
And that's part of what Scott's job is as an intermediary, is to attend to those. But also, I mean, there's only so much he can do as an intermediary, and he can't be your attorney and your intermediary. Right. So you need to have these other professionals help.
What I've found over the years is, of course, I get a lot of referrals from attorneys and accountants.
Right.
And you know this from being an accountant for so long. The accountant's always the last to know. You know, they bring you the form. They say, "Oh, I did this stuff last year. Now fix it for me." And of course, there's no time for planning or anything. So I always call myself the accountant's last defense.
Oh boy.
Right.
So maybe we're sort of leading into our next question. What do you think maybe you can explain what is the role of the qualified intermediary?
Well, the regulations established in 1991 gave us a roadmap of how to do exchanges in this delayed fashion in establishing a number of safe harbors. One of the safe harbors is the qualified intermediary. And so in practical sense, if there's a taxpayer that sells a property today and buys a property later, that's what it is. It's a sale followed by a purchase. However, exchanges are sort of a legal tax fiction. And if you just sell and buy later, that doesn't qualify. That's a taxable event. That does not qualify, even if the properties are like kind and you meet the time horizons and do all that stuff. So you have this fictitious thing that was created by the regulators. It says if you sell a property and take the money, it's a taxable event. If you sell a property and the money goes to a third-party holder, which is the so-called intermediary, then you didn't receive it, but you've designated for purchase or replacement property. And that's the principal role of the intermediary.
Okay. Is there any risk when you choose an intermediary?
Absolutely, there's risk. So let's consider this. Let's consider this case. I've had some clients like this. So taxpayer goes into escrow and is going to close at ABC Title Company or escrow holder somewhere. At the closing, they're selling a property for $5 million. They pay off the loan for $1 million. They got $4 million left over. Now, if the taxpayer gets the $4 million, it's a taxable event, game over, tax due, big problem. So the regulations allow for this qualified intermediary to get the money. So the money goes from the closing to the intermediary, and the intermediary holds it for up to 180 days. Primarily, the aspiration is to use it as a down payment for the next property. Historically, there's not been a lot of controls on the intermediary, so I get the money and I run to Mexico or go away, steal your money. I don't do that, but it's been done. In addition to that, there have been there have been theft of that. There's also been circumstances where very well-known and very well-respected publicly held title companies have actually filed bankruptcy, and the exchange monies were considered a general obligation of the title company, and they've actually been absorbed and lost in bankruptcy. So, you know, they used to say in the seminars, in the lawyer seminars, they'd say you never want to give money to a guy like Scott Hazlett because he'll steal your money and he'll go broke or whatever. And I say, well, that rule certainly doesn't apply to me because I'm not going to steal your money. And in response to that, in California at least, in response to that, there's a mechanism now required by law. You either put a bond on the money, or you set up the money in an FDIC insured account where the bank the taxpayer and the intermediary are all signers on the account. So the intermediary can't take the money unilaterally without the bank being on the hook for the money, which is, frankly, that's pretty cheap peace of mind for the taxpayer.
Yeah. I actually had a client who used a bank as an intermediary, and the bank defaulted on the deal.
Okay.
So, so you need to be confident about the financial strength, or have some sort of controls in place that protect you.
There's actually, at present, there's this deal where you can get FDIC insurance without the limitations if you waive the interest. And we will accommodate that. We charge a little extra fee for that because there's some extra work. But it's certainly, if your bank defaults, the depository bank, if that defaults, then you have this backing, at least from the government insurance fund.
Yeah, and bear in mind, I mean, we're talking about some pretty tight, it doesn't feel so tight, but when you're in that 180-day period and you're trying to get this thing closed, there's a lot of pressure many times as you're getting towards the end. And so if things get tied up because of a bankruptcy action or whatever, there's no extension for an exchange.
Correct.
All right. What happens if the intermediary does default?
Well, there's a ruling, and I'm going to try to cite it from memory. I think it's 2010. Do you have it marked down? 2010,
no, I don't.
14. I think it's 2010-14. Basically, it's treated like an installment sale. Is how it amounts to. So let's say I have a property, sell a property for 100, 30 loan payoff, 70 left over goes to the bank. Now, if my exchange fails because I don't find a replacement property, I don't identify or whatever, and it carries over from one year to the next, that's also sort of considered an installment sale. The 30 is receipt of money, the 70 is receipt later, and so forth. Well, the same would be true of a failed intermediary, except for the fact you don't know when your 70 is coming.
Right.
You may never get it.
And if you never get the money, though, then you don't have to report the income.
That's correct. The gain is
so you may,
deferred forever.
Yeah. So you may find. And actually, I treated it something like that before the IRS ever came out with it, because it just seemed to me to make sense.
Yeah, it's a logical.
That's how it should work.
It's a logical form.
Okay. Can the intermediary provide tax advice?
Yes and no. There's a rule that says that the intermediary is a so-called qualified intermediary because it's a person who's not the agent, the CPA, the attorney, the broker, the banker of the taxpayer. In other words, a friend, or a business colleague. And so from that point of view, it can't. So if you, for example, if your client you've been doing their taxes for 20 years and they say, Mike, we want you to be the intermediary, you can't do it because you're not qualified. You're said to be disqualified. Not that you're a bad guy, not that you're dishonest. You're just disqualified because you're not really truly independent of the taxpayer. So from that point of view, you need to find, and it's usually a corporation that's holding this money. You need to find a corporation which fits within the strict guidelines of being a independent, qualified intermediary in the regulatory sense.
Right.
But there's a second part of the question, and it's interesting. In practice, intermediaries will tell you, use us because we're the greatest, we're the smartest, we know all the rules, we'll help you, we'll guide you all the way. And when the chips are down, they say, I don't know the answer to that, or we do know, but we're not willing to say. So what it really says is you do need a team. You need the tax advisor as well. So what I do, especially when I get the referral from a CPA, I say, this particular exchange might have a little bit of question related to it. It might be somewhat risky for whatever reason. So let's bring the CPA in, because that person's going to have to sign the return and make a judgment about filing it correctly and accurately down the road.
Right. And also related to, it's funny because I've had people particularly related to these, what do they call them?
TICs.
Yeah, TICs. I'm sorry.
Yes.
So they come to me and they said, "Oh, this is approved by intermediaries."
Right.
And I say, "So what does that mean?"
Right.
Yeah, I'll hold the money for the deal, but the intermediaries can't really give an opinion related to.
Well, nor is it, I mean, I know a lot about taxes. I've been
Well,
studying
obviously, yeah.
for years.
Yeah.
And I say to someone says, well, I want to do this and this, and what do you think? And I say, well, here's what I think, but let me caution you by saying my opinion means zero.
Yeah.
It could be good guidance when you compare it to a 5-year-old, but
Yeah.
but it really means zero, because in the end, it's the preparer and the IRS are going to make the judgment.
Okay. Let's see here. We don't have a whole lot of time left, but here's something sort of a recent development area. Can a vacation home or a residence be exchanged?
Now that one I know. It's 2008-16.
There we go.
Revenue procedure. So basically says, so there's a question as to whether a vacation home is held as a business or for investment, now which is one of those central requirements for qualifying for an exchange. So let's say I buy a house in Carmel, California, and it's my second home. But property in Carmel historically has gone up a lot. So I pay $100, and I expect it's going to be worth millions later at some point. Well, that would be a really great investment. And there are a bunch of case law on that and so forth, whether that was my principal intent or secondary intent, or how does my intent come into play? So there's a lot of questions, gray area. Is this qualified or not? So the IRS developed this thing in 2008 that said if a relinquished property in an exchange has been used for the prior 2 years as a bona fide rental with only a de minimis number of days personal use, then it will qualify under the safe harbor. And then there's a similar test for property that you buy as a replacement property. If it's not used personally, then it would be considered a qualified use under the safe harbor. Then comes the question, what would happen if something didn't quite fit under the safe harbor, but substantially was investment property and maybe had slightly more than what they call the de minimis use? Is that still possibly an investment property? And I would say it's a solid maybe, meaning could be positive, and that's a really that's a huddle between the taxpayer and the tax preparer to decide if they want to go in that direction on the return.
Okay. So basically, I think we're about out of time here. So I think what I'm going to do is just wind this thing up. First of all, Scott, I'm going to thank you very much again for being my guest. And folks, Scott is a wealth of information related to exchanges, even though he can't give advice when he acts as the intermediary, but nonetheless.
I certainly can give my thoughts.
There you go. Anyway, but...
Well, I'll tell you this, to fill in the last few minutes. The biggest thing is issue spotting, which is true of a lot of things.
Yes. People
call all the time, well, my partner and I are going to sell this property. Bingo, there's a problem. Partner.
Yes.
So you're going to go together, or you're going to go separately, or my vacation home, or I want to improve.
Yes.
Or I want to, so it isn't so much about really knowing the answer or giving the advice or coming up with a conclusion, but it's really more about these are kind of fuzzy issues that you got to think about. And sometimes people tell me stuff, and I'm going to sell this, I'm going to buy something else, etc.
Okay, Scott, we're all out of time. Folks, hope you found this educational. We'll see you next time on Financial Insider Weekly.